Let's get to our closing bell exchange for Friday. We have Jeff Taylor from Digital Risk with us today, Ken Mahoney from Mahoney Asset Management, Mark Lucchini from Janney Montgomery Scott, Heather Loomis from JPMorgan out in San Francisco. And we got Rick Santelli in Chicago as well. Heather Loomis, let me start with you. What did you make of the jobs report?
I thought the jobs number was pretty strong. I think that it continues a long trajectory of pretty good prints on jobs. And, we are encouraged to see that development. Ken?
Yeah, I think it's going back to this old Wall Street saying that goes something like this. When markets climb, they tend to take an escalator, meaning they go up a little bit at a time. But when stocks come down, they come down by way of elevator, which we saw a few weeks ago. But what's so surprising and how strong this market is, we took the elevator back up again. So we have this kind of V-shaped recovery time and time again. And we have to kind of, as investors, live with this volatility and embrace it.
Ken, tie that back, if you would, to the jobs report. So JPMorgan, among others, are saying they look at the data and see rate hikes pretty much imminent now. If in econ speak, imminent means maybe within the next year. Why do you, does that have something to do with the snapback that we've seen from markets here or no?
I don't think so. I think the market still feels that, the Fed tightening is still a ways off. And they probably think Janet Yellen Company is going to wait a little bit longer to get more evidence that we have a runaway economy or inflation.
Jeff Taylor, what about that? Would we really want, of course we want stronger jobs reports because we want people working. But from an economic standpoint and the financial markets and so forth, do we really want that much stronger? Because that just means the Fed is more likely to be raising rates sooner rather than later. I'm thinking as a market person now.
Yeah, you know what? I think that we always going to want to see a strong jobs report. But really kind of stuck out to me in today's numbers was we had a 6-year high for that 25 to 34-year-old age demographic of employment. It's something we track called the employment population ratio. It's at a 76% in the month of October, which again, a 6-year high. If we start getting that age group back into the housing market and they start to be employed and they start to actually, the first-time home buyer takes advantage of some of these low interest rates, that could really ultimately start from a broader economic perspective, start to really be a catalyst for the housing market coming back and for a broader economy.
Jeff, you also have an interesting point here, though, about one of the more difficult pieces of the labor market recovery. Talk about the difference between a lot of the jobs we're creating and have created here today compared with the ones that were lost.
Yeah, that's a great point. So the jobs that are being created today are about a $40,000 a year annual salary. 6 years ago, they're about $60,000. So when you look at, that's a huge delta, that's about a third. So when you're looking at situations where people are saying, okay, I want to make that significant first-time purchase, a house, a car, the savings are much less. So it is harder, although the jobs numbers are improving, where they're actually putting in the bank for savings for big purchases, that's not necessarily translating into their savings account.
Mark Lucchini, obviously a very volatile month of October for the U.S. equity markets. November, not so much. What is the next catalyst you're looking for to move this market, and which way do you think it goes?
Well, Bill, I think directionally it goes upward over the next 6 to 12 months. But we've recovered 200 S&P points here in a matter of a couple of weeks, and we're back up to where we were in the middle of September, which is, I think, at the intersection of full valuations in the U.S. equity market that demands good news. So today's report, while on balance, I think was pretty good. It just met expectations in terms of what the market demands, given a 16 times forward multiple on the S&P 500.
Do you think we just keep meandering here, though, in the meantime?
I could see us in a fairly wide trading range that grinds higher, predicated upon earnings growth. I think that we've seen the best of market multiple expansion driving equity prices higher, which means we're going to see more demand placed on earnings growth. And so far, we haven't been disappointed on that front, certainly for Q2 and Q3. So if we continue to see mid to upper single-digit growth, that's where I think the share price appreciation can grow commensurate with.
Rick, there's a whole transformation happening here, though, and I would like, if you can, to give us a sense of what message it's sending. The combination of the stronger U.S. dollar, the steady drift upward we talked about yesterday in U.S. interest rates, what's happening in the oil space now. What is the message here?
Well, I think the message on energy is terrific. It's all about the American energy renaissance, and I think we're writing a chapter of repricing global oil. And even though our oil is fungible, and as you've pointed out many times, it's not necessarily going to make prices drop dramatically here. If you're the big boy and you're throwing in, if we get exports, and I think the new Congress will consider that, then you really can make a difference. I think we're changing the price structure of energy for the next generation. That's a good thing.
Higher or lower, Rick?
Oh, I think lower. I think the technology is just amazing. Yeah. And, you know, all these stories about fracking contaminating the environment, you know, there's stories out there and independent studies finally getting done by major universities that show that it isn't the technology of fracking that is a problem. It's the state of how they build the wells. So, of course, you know, there are some uses for the government. This is one of them. Just like building a house, they need to have some of this signed off on. In terms of interest rates, you know, today it was easy to tell if the market was happy or sad with the quality of the jobs report because interest rates dropped like a rock. And I think that says it all. It's good, but not good enough. And with regard to any of the other issues on the dollar, listen, I think the dollar going up, I've always thought that I'd rather have a stronger dollar versus a weaker dollar, but it really is a European and Japanese issue. Those are the movers and shakers that are putting the dollar index where it's
Rick,
at.
I am scratching my head a little bit at what interest rates are doing, because it seems like, again, while we're still not quote unquote there, more and more people are looking through the details of the jobs report and even sort of the nascent increase in wages and saying, you know, signs are pointing towards the Fed moving next year. It's not as if markets have been pricing in anything very hawkish. So why do you really think it's a jobs report today? Is there something else happening in the world that would have pushed rates lower?
No. It was
I don't really
without a doubt.
understand it.
Now, it was the jobs report. We were at 239. The minute it hit, we were basically down at 234, and then we've dripped down to 230, 231. The Bund acted the same way. The DAX, all the equity markets around the globe acted the same way. It wasn't a great number. It was a miss. It was a good, improved number. But once again, the U.S. economy is better than all the other economies of the world. So if we go down to zero growth and they're at -2, are we supposed to be happy? The relative evaluations only take you so far. We need 400,000 jobs to make a dent in the 92 million people that aren't looking for work anymore. It's a step in the right direction, but they've thrown everything, including a Volkswagen and a kitchen sink, the last 5 or 6 years to get this going. It really isn't enough.
Yeah, we need free toasters now as well. Yeah,
I think to Rick's point also, we still have so much slack in the labor market. Until that's actually absorbed, we're not going to see a rise in wages. It's going to continue to probably to hover flat, so we really got to see that slack taken out of the labor market.
Let's make this meaningful to investors. Let me move on to investment sectors here. Ken, I'm sorry. Heather Loomis, would you buy energy here if you buy Rick Santelli's notion that we're repricing the energy structure here in the United States? In fact, globally, would you buy energy here? Is that good or bad for the industry right now?
Right. Well, we're looking at it from a bond market perspective, and you see energy really at play in the high yield portions of the market where a lot of E&P companies have come out, some with much more leveraged structures, and we are not buyers of energy in the high yield market at this point right now.
Ken?
Yeah, you know, we think oil is a story for the remainder of the year and for next year. If you kind of look at it, it's not, I mean, look, we know oil prices are low, but it's not ephemeral or short-lived. Like everything, okay, by January it's going to go up again. By February, no. We think it could stay this range for a while. Think about the compounding effect as if you're going to the mailbox every day picking up a check from the government. That's the stimulus that's involved when you see lower oil prices. So we think it's a very net positive. If oil could stay down here for an extended period of time, we'll start seeing revisions for GDP, earnings for companies. It's a really, really net positive.
But you know the CapEx point that we got to bring up here, Ken, which is that the ton of the CapEx, the capital expenditures that U.S. corporations make in this economy, it's a big contributor to GDP, and a lot of that is from the energy and production space. So you take some of that offline,
right.
You're going to have a drag.
Right, but 2/3 of the economy is consumer-based, particularly if people feel better about it when they go to their mailbox, so to speak, and get that extra stimulus check, which is a form of this foreign tax we call oil. I think it's a net positive, though, yeah, there's an offset from CapEx spending from companies with
Heather, could I just quickly go back to the question that Rick and I were debating as well? I'd love your perspective on this one. I mean, why did interest rates move lower on the back of this jobs report, which again shows, if not amazing progress, steady progress towards conditions that the Fed might ultimately respond to next year here?
I think it was the wages component of the jobs number that people were focused on, because that showed about 2.1% year-over-year growth. And from the perspective of the market, that simply wasn't enough to push the Fed's hand towards tightening. So you saw the Fed funds futures react and begin pricing in a slightly longer date for the first Fed tightening then.
Got it.
Thank you all, folks. Have a nice weekend. Thanks for joining us today.
Thanks, everybody.